Yeah. Trading the Fed meeting, this is something that is super exciting to me. I remember being at the Board of Trade, and I'm sure, Pete, you remember this as well. Everybody came in for this event. Like, there were people in my prop trading group that I hadn't seen for weeks and weeks and weeks, and they would show up inevitably for this event to day trade. People who traded only in Asia or only in Europe would alter their sleep schedule to show up for what is about to occur in about 30 minutes here. It is probably the biggest thing on the calendar for the next couple of weeks, right?
Yeah, absolutely. And you're right. We would see faces we hadn't seen in a long time pop their heads in and look to see for some opportunity. Why? Because markets tend to have an initial reaction. You know, one of the things I think, and I don't have the statistics, but that amount of reaction, I think part of the reason in your generation of mine, they pop their head in is that out of products like the long end bonds, you could see a 3-point or 4-point move, which is a substantial move. We don't tend to get that kind of reflexive move anymore. It seems like, we'll get a spike. In other words, the market will cover a number of ticks very quickly, but it doesn't get to be 2 points in the bonds or 3 points in the bonds. It's 1.5 points. It's 1.25 points. So little less. It's still a very interesting trade because it's rapid movement on, less than, I don't know, news in general, how it actually affects markets at any given moment. So I agree with you. This is one where, and it speaks to, we had a relatively quiet afternoon yesterday, and we're having really a quiet day today. Everything inside. S&P is really trading between a 12 handle range all day long.
And that's why, you bring up the fact that interest rates have gotten to be less volatile in the last couple of months, especially around these meetings. We've gone from, that ZB future moving $2,000, $3,000 on a Fed meeting day to $1,000 or $1,500. And we're about to look at the small exchange products, which are thankfully smaller, but the same problem arises of volatility getting lower and lower. But as we know, Pete, you and I know this, and everybody out there in the audience who's traded for more than a couple of months knows this, volatility gets lower and lower and lower until it doesn't. And the ZB future, goes from 3,000 to 2,000 to 1,000. It doesn't go to zero and stop moving. At some point, it goes back to that volatile setting. And there is an iffiness around the market here today, Pete. You bring up all the inside markets and equities and interest rates, which is pretty traditional going into a meeting. Not a lot of people moving markets around or wanting to get a new trade on or push these markets around going into what'll occur in about 30 minutes at 1 p.m. Central Time. Now, this is what has caused this low volatility, Pete. The fact that there's less than a 5% chance that they hike today, and that overwhelming odds of 97% chance that they don't do anything, 0% chance that they go negative. So I think that's pretty much off the table. And there's just a little bit more than a 10% chance that they do anything by the end of the year. Now, Pete, this is where that lacking volatility comes from. And you might say, oh, well, then who even cares about this Fed meeting? Why would I even show up to day trade it? But I would contend that these probabilities are, less than, they're probably not going to hike today. Fine. But that 15% chance or whatever it is that they hike by the end of this year will absolutely change today. And these prices in the small 2-year yield will absolutely move with them. And this is what we're talking about. And like I said, it's a 10% or less than 10% chance until it isn't. And this is what I'm looking for today. I think that we might get some shifting around in this. What say you?
I agree. I think especially at the shorter end of the curve, we talked about that yesterday. I think we still consider 18 basis points as cheap.
Yes.
They've been, the chocolates have been saying for 2 years, don't think we're going to be in a rush to change these rates. And you're going to get a lot of messaging from us before those rates ever change. So not necessarily saying I'm taking them at face value, but it certainly doesn't mean they're moving them below zero. So where's
Sure.
my downside? We're at 18 basis points. Can it get cut in half to 9 basis points? Sure. But I like I like the upside trade much better than buying,
Well,
a 1.64% 10-year right now, even though we know historically that's very cheap. But I like this part. It'll be interesting to see, Frankie, because I think you and I, from our years trading rates and trading short-term rates like Eurodollar futures, the action is in that shorter end of the curve usually. And it's fascinating because it's in the shorter end of the curve, but farther out on that curve. And what I mean is it'll be Dece of 2022 90-day paper that will move, not the current front
which
one.
lines up with the duration of the 2-year,
right?
So you're absolutely right that this 2-year is a perfect barometer for those probabilities that could shift. And I'm glad that you brought up, where can this thing go to the downside? Can it get cut in half? Sure. Can it go to zero? Yes, of course. The small 2-year futures can go to zero, and the 2-year yield could go to 0% even. I did some research going back to 1990. The lowest that this market has gotten is 9 basis points. So like you said, going to 90 cents in the futures here is literally the low of the low for the last 3 decades. I like this position long, the 2-year. If you do think that rates are going to move higher at some point, I do think we see an asymmetric risk return here, where historically this market has only gotten as low as 9 basis points, which would be 90 cents in these futures here that are right now at $1.80. Right. The average, Pete, for this 2-year, as you know, is well above a full 1% or 100 basis points. So I like this as something that could shift, when the Fed comes out and they say, like they have for the last several meetings, that we don't have any interest in lifting short-term rates for the time being. When you get lulled into the complacency of, they're going to just keep saying that into perpetuity, at some point that language is going to change. And they're going to go from saying, we have no interest in lifting short-term rates to, we might look at lifting short-term rates at some point. And this thing will take off before they actually move those rates.
Oh, absolutely. Right.
That's the idea of potentially getting long during a complacent period like now, right?
Yeah, and I'm glad you pointed it out, because waiting for them to do it, the market probably will have been well communicated. And I think the Fed is in this game of, it's so funny, the Fed in the 80s trying to calm inflation would cut rates 50 basis points at 2:30 in the afternoon. It's like, they really have to do that just after I close, and I've got a 200 lot yen position on just from an MOC, and torture us all in those. They wanted to attack and unsettle the market in ways to add some unpredictability. Very different Fed now. They telegraph everything very, very clearly. So you're absolutely right. Those rates will have, to a good part, already moved to the level that they have kind of talked about before they actually moved up. So it's a very good point. You can't wait for the action and to say, all right, now I'm going to jump on. That move will have been taken well into play.
Isn't it funny that, and I looked at this, I went back to several decades of data. I looked at past Fed meetings, and we're going to talk about the 10-year here in a second, because I think that's a better potential day trade for the Fed meeting today. But I just want to stick on this for one more second, because the meetings where they actually hiked rates, Pete, in the last several years, the day of the actual hike was some of the least volatile days in interest rates, because the most volatile days were the meeting before, or the couple meetings before, where they finally go from saying we're not hiking rates to we're looking at hiking rates. Immediately, that futures contract prices in all of that in the future. And if you're waiting for the day that they actually hike, you've already missed it. So this is an interesting one. The probabilities right now are slim to none that they hike. I don't think they're going to hike today, but slim that they hike in the next year or so. But those probabilities are slim until they aren't. And it's the same with anything, right? Like, everybody wants to be hip to the next thing when it's already happened. Like if you told me, like, if I was like, oh man, baseball cards, I wish I had a lot of them right now. It's like, yeah, no crap, man. Like, baseball cards took off 6 months ago But it's a matter of trying to get in front of these things when they are complacent. I think that's a really interesting concept for this 2-year. Of course, I could be wrong. We'll see what happens. Pete, I want to talk a little bit about day trading, and then we'll get into splash into futures, and we'll talk about actually placing some orders here. But here you can see that yields historically move about 1.3 times their usual movement on FOMC days. So what does that mean? We have a 10-year product here, which is that 2-year is great for like placing a long-term bet on where you think short-term rates are going. Mm-hmm. The 10-year is a better scalping vehicle for us here. And what this means is that if the 10-year is moving about 30, 40 cents, today I would expect about 50 cents in range. And that's where I'm going to set my in and out points. Same with the 30-year. It's very similar, just like expecting a slightly larger range. But you brought up something interesting earlier, and let's end on this, and I want you to expand on it. When we have Fed meetings, we tend to see actual fundamental shifts in short-term rates, but we also tend to see a lot of noise in long-term rates that doesn't end up concluding in much. And that's why you'd much rather scalp in the 10-year and the 30-year relative to the 2-year, right? Like you're going to set some ranges and look to just get on the other side of things.
Well, you know what? It's a fantastic observation that only comes from a professional trader who has traded these, but you're absolutely right. Many more unique price points, which is what we want in terms of tradable opportunity. And just from, and I'll only mention this in passing, from a fundamental standpoint, the Fed buys longer dated government debt, but really what does it control? The overnight funding, Fed funds, the overnight lending rate at bank-to-bank lending. So that's the one thing they control. They can speak to what they think about longer rates and pieces like that. But this is why we see the reflexive movement throughout all the different maturities. But where is the trade? It's in these longer dated instruments because there's less sticky glue that they can put into those, but there's more tradable opportunity for us.